I've done it.
Press the one,
I've done it. Yep, we're live. Good morning. Apologies for a few technical difficulties that's delayed us in this monthly webinar, but we're with you now, and it's the July market pulse. So we're already into the second half of the year. Today's session focuses on the return of macro rather than geopolitics as a key driver for financial markets, and we've seen that with regard to commentary subsequent to the June monetary policy meetings from the European Central Bank and then the Federal Reserve, finally the Bank of England. Interesting comments with regard to we've been seeing in terms of where monetary policy might be heading, and it looks like the Bank of England's decision to do nothing might pay off as far as things are moving forward. So the session is entitled Return of the Macro, and in this we're going to be looking at things like growth and where we see the outlook for growth in the second half of this year and into 2027. We'll look at interest rates and inflation as usual. We will look at geopolitics now that there appears to be some something happening with regard to a peace deal. We've at least had a memorandum of understanding between the US and Iran. And then finally, we'll switch things onto the FX market. So without further ado, let's delve into the topic. As I say, the order is global economy, inflation, interest rates, geopolitics, and then FX. And I will make a few remarks with regard to domestic politics as well, given what we've been seeing. So in terms of global growth, is it getting better? Well, absolutely, it's getting better than it was, because previously, with the onset of the Iran-US war, things were getting worse. And so I think we can at least say that for the time being, things have stabilized. The global growth outlook, should this peace deal actually come to fruition, ought to improve, but it might take until 2027 to see those signs of improvement. I think as far as the major economies, the US is still likely to be the one that performs the strongest. Then it's a battle between the Euro area and the UK for which one performs the least worst. But other economies are also performing poorly. If we look at Japan, if we look at Canada, and we look at several others, then they're not meeting the challenges of global economic activity, and they're certainly being negatively affected by trade and the more aggressive stance, the more interventionist or protectionist stance that we're seeing from global trade. So global growth, the outlook appears to be one of improvement, but probably it's next year rather than this year where we'll see it from most major economies. If we look at inflation, we've definitely seen some increase in inflation, particularly in the likes of the US and also to a lesser extent in the Euro area. But it is worthwhile noting, over the last couple of months at least, both the UK and the Euro area have seen their inflation rates underperform current expectations. So consensus was for further increases in inflation rates on both a headline and core basis, and that didn't come through in the official data. So it will be interesting to see as we head through into the end of July meetings for the central banks, whether or not there's a recognition of this undershoot on inflation. We may have seen some of that in the ECB's forum yesterday, where we had all three of the central banks speaking, and there was definitely a recognition that inflation pressures have eased over the last few weeks. I'm not sure that we can say the same thing for other economies. So if we take Japan as an example, one of the key inflation pressures at the moment is currency weakness, and we haven't seen an end to that, even though the Bank of Japan might be talking about a new approach to dealing with that currency weakness. And moreover, I think as far as the UK, the US and the Euro area is concerned, it's about second round effects. It's how this feeds through into wages, into shop price inflation, and into services inflation. And I think everybody has made reference to the fact that services inflation is one of the key problematic areas for monetary policy at the moment. Question, of course, being what will monetary policy and small adjustments in monetary policy do with regard to adjusting inflation rates. And if we look at interest rates, there's been a material shift in expectations. I mean, even over the last 24 hours, so I did these slides yesterday, and even over the last 24 hours, there's been a further shift. So the UK and the Euro area now, by the end of the year, there's only an 80% chance of any hikes for both of those economies. For the US, it's still around about 140 to 145%. So that means that there's one rate hike definitely priced in by the end of the year. And then the prospect around a 40 to 45% prospect of another 25 basis point hike priced in by the end of the year as well. And that first rate hike from the US is still expected to come in at around about October time. I'm not convinced by that personally. As I say, I think the risks as far as interest rate hikes are concerned have definitely fallen away over the course of recent weeks. But those higher rates being less of a risk may well have a material impact on how the foreign exchange markets move over the course of the coming few months. We did see on the back of the outturns from the interest rate decisions in June some improvement as far as interest rate hike expectations were concerned from the likes of the Federal Reserve, and some reduction in the prospects of interest rate hikes from the likes of the European Central Bank, whereas it was a steady as she goes type of outturn from the Bank of England. But I think, and I thought it interesting that the Bank of England governor, Andrew Bailey, thought it necessary to turn around and say, hey, do you know what? Interest rate cuts aren't on the table yet, trying to dispel any thoughts of the fact that because inflation pressures have eased and energy prices have dropped lower, that would be sufficient to drive the debate as far as interest rate cuts are concerned. So it's potentially a long period of on hold, probably into the year end, what we're likely to see. And then the possibility, and I stress the possibility of lower rates if inflation pressures continue to ease in the early months of 2027. So moving on to geopolitics, and can a deal be done? At least they're talking. You know, the US and Iran are talking. They've got this memorandum of understanding, but I think the positions remain very, very far apart. And the particular issues around the Strait of Hormuz, I think, are the biggest problems here. So if we look at the likes of navigation and transit and Iran's position on this, they are talking about them administering it, and there consequently being a toll or a fee for that administration in conjunction with Oman. Now that's a deal breaker as far as the US is concerned, and also I would suggest for the major other oil exporting nations around the Middle East. So I can't see that being able to be pushed through. Arguably as well, I think there are other issues around the Israel and Lebanon ceasefire, which is tenuous at best. And so even though we've seen oil prices falling, we've seen yields dropping back, we've seen equity markets recovering, and we've seen the financial markets generally improving in risk appetite, which has led to something of an improvement in the likes of euro against the dollar and sterling against the dollar in recent days. We're still in a position where the dollar is stronger than it was before the memorandum of understanding was signed, and that's because it's the macro that markets are really now focusing on, not this geopolitical risk issue. But if this geopolitical risk issue does rear its head again, if the talks fail, if there's another exchange of fire between the US and Iran, then that could create additional supportive noises towards the US dollar and pressures on sterling and the euro accordingly. So if we look now to the FX outlook, and it hasn't materially changed, because I've always been something of a negative Nancy around sterling and the euro versus the US dollar, then I'm still predicting that we will go lower in sterling dollar and euro dollar. Worthwhile mentioning as far as sterling is concerned, that although we do have this focus on the macro, we also have one eye on what's going on in Westminster. So Keir Starmer is still Prime Minister for now, but is due to stand down either in a couple of weeks' time if there's no further challenges to the position for Prime Minister, and it's only Andy Burnham that is able to put his name forward, or it will drag on through the summer and towards September if there are other challenges to Burnham. What I've found interesting in the UK politics situation is that there's not really going to be much of a change in terms of policy emphasis. There's not really any new money. There's not really anything that we're likely to see that will materially alter the growth trajectory for the UK over the course of the next 12 to 18 months. And realistically, I think from Andy Burnham's position, he's probably as popular now as he's ever likely to be, unless he's able to deliver significant change as far as the macro economy is concerned, particularly around domestic spending or indeed taxation. If we also look at domestic politics in the US, we're now only several months away from the US midterms, and we've seen that really kick into high gear. So that could be another factor that has an effect on currency markets, something that creates volatility alongside the USMCA review, which is due to happen over the coming months. I just think that that all of these things will drive volatility, which has been largely absent over the course of recent months, and that consequently ought to then create conditions where there's less certainty on FX, and where I think clients that we speak to will have to rely much more heavily on the views and opinions that are being produced, as well as their gut instincts to determine when a good time to layer in that next tranche of hedging will be. Notably, sterling euro is at 12-month highs at the moment. We sent a note around about that yesterday. We've talked about this on a number of occasions. It's not that sterling is strong, it's that the euro is weak, and this is being driven predominantly by the fact that the ECB is very rapidly reversing course on the prospect for further euro interest rate hikes. So the prospect again of a long period of on hold is very different to what we were seeing less than a month ago, when the European Central Bank was suggesting it was going to hike interest rates 2+ further times, or at least there was a suggestion that they would do from market pricing. The noises also from the euro area economy have been, broadly speaking, weak. I mentioned that Spain is an outlier in this, but there's still this underlying weakness in both the French and the German economies that I think will make it difficult for the European Central Bank to tighten monetary policy additionally, and that means that the euro against the US dollar and the euro against sterling might find it difficult to make further material gains versus where we got to only a couple of short months ago. So risks here very much asymmetrically skewed against any renewed euro strength, and instead I think we could be in for a month or two of additional weakness, something that wasn't really expected, as I say, prior to those June monetary policy meetings. Just one final thing as well on the currency market side of things, which is that we have seen CAD weakness against the US dollar, again going into the USMCA review. I think that's noteworthy. Excuse me. As far as the Mexican peso is concerned, we've seen some renewed weakness there as well. Again, USMCA related, most likely. Seen some weakness as well with regard to the Japanese yen. And maybe we're seeing a shift in the way in which the Japanese authorities do policy. The reason I say that is there was a Reuters story out overnight talking about the fact that they might not sort of jawbone or flag any possible interventions, instead just taking the markets by surprise and doing something that's very un-Japanese-like, possibly, as far as these interventions are concerned. But that could shock the markets. It could lead to quite a lot of destruction as far as the gains that have been made in positioning against the yen over the course of this year. And consequently, I do think that the issues around the yen are for more uncertainty, greater volatility, less predictability, and that might be something that has to factor into planning over the course of the coming months. But I think overall, the big question, and it's the title of this slide, is this dollar strength that we have seen, how long will it last for? Because predominantly at the moment, it is driven by the fact that markets are now expecting the US to hike interest rates, and that is a very different place to what they're expecting from the likes of the European Central Bank, the Bank of England, even the Reserve Bank of Australia. You know, we're seeing the Federal Reserve in a very different place. So I think that's a good place to stop in terms of the formal part of the presentation. Now, very kindly, we have seen some questions submitted, so we're going to run through those. But if you do have any questions, there's a quick summary slide. By the way, you will be able to see the slides later on, but that's just recapping what I've already said. So if you have any questions whilst I'm answering the ones that have already been pre-submitted, then do feel free to populate the comments box. So the first question is, what are the major risks to the yen in the next few months, in your opinion? Well, I think hopefully if you read the daily, you may well have seen me already answer this. But I think if the Japanese authorities do take the markets by surprise in a sizable and unplanned intervention, you could easily see dollar yen moving down by between 3 and 5%. And then the other currencies, so sterling yen and euro yen, are likely to follow suit. That it might give both sterling dollar and euro dollar a little bit of a boost higher. So it might not be the same scale of move that we see in dollar yen, because that's where I'd expect all of the intervention to take place. But even so, I think you could be seeing a very sizable move lower in both sterling yen and euro yen on the back of a move lower in dollar yen. And it's that potential positioning destruction that I think the market should be wary of, because everybody has been trying to use the yen as a funding currency, and so they are very asymmetrically exposed to these risks. So thank you for your question. The second question says, do you see the UK government being able to produce stronger growth or increase confidence in the UK into year end? And what does the change of government mean for sterling? Well, first and foremost, I'll answer the second part of that question first, which is I don't think it makes any difference, because ultimately it's about policies and not personalities. So it doesn't really matter who's at the top. It's about the policies that they are prepared and able to push forward with that will determine whether or not sterling moves higher or lower. So I would re-emphasize that the moves that we're seeing in sterling at the moment have nothing to do with this change at the top in UK government, and everything to do with what we're seeing in monetary policy in other jurisdictions. In terms of will they be able to produce stronger growth or increase confidence in the UK, I don't think it's in their hands. Again, I don't think any policies, even if they were to bring them in now, would have sufficient time to embed in order to produce materially better outcomes economically. So you're really looking at 2027 for any policy pronouncements to take hold and have a positive or negative effect on the UK economy. But I'm not trying to be mean-spirited towards any a new prime minister or indeed any Labour government. I just think that it is unrealistic to expect a short-term time horizon like 6 months to see any material change in confidence or indeed in economic activity. Our third question is, what do you think the range is for sterling euro over the next 6 months? I think this is intriguing because we're, sort of pushing towards, well, we are at 12-month highs as far as sterling euro is concerned. I think if we were looking on the top side, then there's the possibility of 117.50, maybe even 117.70, 117.80. Downside, I see greater risk. So that's, maybe 1%, 1.5% upside risk, downside risk. I mean, I think we're talking about the possibility of 114 or even 113 over the next 6 months. And there's a real risk that sterling actually then runs away and heads lower, because there is this material underperformance in the UK economy. Forget about the Q1 data. The UK economic data didn't really marry up with any of the other economic survey data or economic releases that we'd had. So Q1 GDP is very much the outlier for UK economic activity, and I think we'll be lucky if we produce 0.1, 0.2 percentage points of growth each quarter from then on. Realistically, that then means that sterling euro potentially has some downside risks associated with it. And I think if we saw one or more members of the Bank of England stop voting for rate hikes, that could have a materially negative effect on sterling as well. So downside risks potentially larger than upside risks. 114, 113 is the risk for the lower boundary on sterling euro, in my opinion. Potentially even lower than that. I mean, that's how I see it. I am a sort of negative Nancy as far as sterling euro is concerned. I make no apologies for that. I just think that the UK has very little going for it if you're an investor. What about euro dollar? That seems incapable of capitalizing on dollar weakness. Why not, and where next? Good question again. As far as euro dollar is concerned, I think their problems lie in the weak growth outlook. They have some political issues as well. They have a war on two fronts that's being fought at the moment, which is creating stresses in commodities and energy. So those are some of the key reasons here. But equally as well, the European Central Bank have decided to reverse course relatively quickly on the possibility of rate hikes. And so I think that is the reason for the move lower that we've seen in euro dollar, and it's the euro's inability to capitalize on dollar weakness seen recently. And then there's one or two final questions that I'll try and address very quickly. So the first one is, where do you see dollar CAD in the months ahead? I think downside risks are sort of 138, 138 and a half in dollar CAD, upside risks towards 144, 144 and a half. So broadly speaking, we're in the middle of that at the moment. But overall, I think if pressed, I'd say that the risks higher are probably greater or probably outweigh the risks lower just on this USMCA review and what could come about from there. And then the final question that we have, because you haven't posted any questions here as yet, are further hikes in interest rates now off the table, and what could rekindle those risks? Well, first and foremost, no, they're not off the table. As you've seen from the US outlook, the markets are still pricing for one and some further rate hikes from the Federal Reserve over the course of the remainder of this year. And there's still a high probability of hikes from the UK and from the European Central Bank. And it would only take something to go wrong as far as the position in the Middle East is concerned. And I think you'd get a return or a resurgence of inflation risks to the upside. And that would be sufficient to then cement those expectations and cement opinions on the central banks that rate tightening is required. I do think there's one other thing here, which is that all of the tariffs and quotas that are being levied around the globe are anti-competitive and potentially also inflationary. And that is something that seems to have been lost with the Middle East war. But overall, I think those are your risks. And hopefully I've been able to answer all of the questions that have been pre-submitted. So it just leaves me to say thank you very much for your time and attention today. I hope you found the session useful. If you scan the QR code on your screen, which I will just bring up now, there we go, then that takes you to a feedback survey. So please, if you could offer us some feedback, tell us what you like, tell us what you don't like. We really value your input. More broadly, if you'd like to discuss these themes and how they might affect your own exposures, then do let us know. We'll be happy to discuss your FX strategy throughout the remainder of 2026 and into 2027. Please do reach out to your usual Money Call contact, or if not, you can reach out to me via LinkedIn or via email. We're very happy to help and support. Thanks again. I wish you a very successful month ahead. If you're planning to go on summer holidays, fantastic. Enjoy it. Come back refreshed, and we look forward to speaking to you again in early August. But thanks again, and goodbye.